A very good afternoon, everyone. I am Pragati, host for today's call. I track macros and strategy. I'm sure all of you have heard or read about the AI Capex in some way or the other. In today's call, we cover a host of slides putting a different perspective to it. Other than that, Sahil will talk about India valuations in detail, where we are and what that means in historical context. So with that, this was just a gist. I will have Sahil take over to cover the presentation. Just as a side note, you can put in your questions in the question answers tab on your screen, and we will take them collectively towards the end. Over to you, Sahil.
Thank you, Pragati, and good evening to all of you. So we'll discuss the uh, August edition of DSP Netra. And so in this edition, as Pragati mentioned, we've demarcated into roughly two sections. First section is more about the AI capex globally, and we try to decipher it. And the second section will be more focused on domestic markets. We'll talk about valuations particularly, and a bit about the India capex. So first we'll start about the artificial intelligence, the amount of capacity expenditure or capital expenditure which is going in. And we've written here is the best behind us. That's the question that we are grappling with. The reason that we are seeing a huge number of excesses in terms of capex in this arena. So, for example, look at this data that is there on your screen now. If you look at it, we've highlighted a few eras historically which has sort of been, breakneck in terms of capex. Huge amount of capex has happened in some of these specific segments historically, like railroads in US in 1880, 6% of GDP. In fact, if you look at this data for UK in 1880s, that number was 20% of GDP. No other era has seen a bigger sort of capital expenditure bubble than railways. But now, when you look at the AI capex cycle, it has eclipsed all the other previous, you know, bigger expenditures which have happened. And why we have taken only two, telecom and US oil and gas, because all other, when you look at them, were much smaller in comparison to the capex that we are seeing now, right? So at this point in time, artificial intelligence capex is about 2.4 to 2.7% of US GDP, and this data will be similar, maybe slightly smaller, but similar when you compare it on a global scale also. And we've taken, one number that you can take is aggregate number of all the capex that AI and AI related firms are doing. And the other is that we've tried to extrapolate it using NVIDIA's revenue, which again comes closer to 2.7% or so. So roughly between two, let's say 2.5% of US GDP. And US GDP right now itself is about $32.5 trillion, right? So when you look at this number, you know that roughly about $1 trillion in capex spending is happening in US, which is a very, very large number. We haven't seen this kind of a number happening for any other segment. And does this mean that this is an end of the cycle? Certainly not. But these numbers are very large, right? And the question is that what is it creating in return? That we'll talk about once we go ahead. We'll take another look how large this number looks, right? So we've taken some example of very highly capital intensive sector, which is oil and gas, which is the lower table that you can see. And we've taken some of the largest oil and gas companies in the world. And you can see that we put their capex numbers. And over since COVID, they've spent about $900 billion, so less than $1 trillion on capex. And the AI capex is about $1.3 trillion or $1.29 trillion, a very, very high number. In fact, we don't even need to put a company like Nvidia, which doesn't do a lot of capex. Even if we exclude that, just about four or five firms or hyperscalers, like they are called, are spending enormous amount of money, on AI capex. Now, these companies are effectively, putting in the capacity for the future, which is what the current expectation is. Now, what will this future deliver is the question. So, for each, if you are spending about $1 trillion or more, right, in 2026 alone, the AI capex will be $1 trillion, right? And we are right now, when you look at this data, it's only for five companies, and over the last 5 years, it's 1.3 trillion. But the amount of capex that is being utilized, what will it create? Um, through this capital expenditure is the question that we need to answer. And we have an answer at the last slide, and we'll talk about that. But that number is extremely large. The value that it has to create as of today is not available. It's not visible, but of course it can become visible. For example, just like the dot-com era, it had huge promises. It made huge amount of promises to the world. Eventually, all those promises were delivered. Unfortunately, they were not delivered in the time frame that the markets wanted, which was maybe 1 to 5 years. It took about 2 decades to deliver. Maybe AI will also deliver similar outcomes, but we don't know the timelines, right? And the market is expecting those timelines to be very, very short, maybe in the next 1 or 2 or 3 or 5 years. Uh, the next is, one of the most important charts in the whole report is if you look at this chart, it gives you the investment done by businesses in United States, the upper panel, which is the gross private fixed domestic investment. It's a long word, but what it means, the businesses spending money to purchase computer and peripheral equipment. And you can see this line, the data stretches back to April 1980. You can see that there was a clear boom in the 1990s, huge amount of spend. It had accelerated significantly. You can see the YOY changes were very, very large, right? And then you had the dot-com era. Then there was a huge slump. In fact, you can see that it went to minus 20% YOY. If you look at the data clearly, you will notice it. But what we are seeing right now is unprecedented. We haven't seen this kind of a massive uptick. In 2026, the data, the most recent data that we have is printing numbers like 75% YOY growth, right? And the total expenditure has gone to about $96 billion. This is only the United States. When you look at the entire world, the expenditure roughly, according to our calculation, is about 585 billion, about 600 billion. And how we have done it, we have taken the HS code of how much computer hardware and components are being traded across the world in terms of exports, which means that if somebody is selling, then somebody else is buying, right? And that number is now approaching the peak of the dot-com era when you look at this number as a percentage of GDP, right? Now, this number is significant. Why? Because this is also equivalent to about 5 to 6 years of demand. So, to put it in simple words, the amount of computers and equipment that the world buys in 5 to 6 years was bought in the last 2 years, right? So we've pulled forward the demand for maybe the next 5 to 6 years. And when that happens, you get signs that probably some overcapacity is being created. Now, the current expectation or narrative is that this capacity is needed because we have a new technology, which is AI, which needs a lot of computing power, and therefore the utilization is high. So the last slide, I asked you a question that whatever capex is happening, what is the output, right? And by output, I mean what is the revenue that AI is generating profitably so that the capex that is happening has some return on equity or return on investment, right? That we'll try to answer at the end, but as of now, the answers are not very clear. Maybe they will become clear, but as of now, they are not clear. This slide talks about, how and why so many large hyperscalers and other companies involved in artificial intelligence are able to become so profitable, have so high ROEs in spite of doing so much capex. Of course, now they're doing capex, their possible cash flows will fall. But one important ingredient of this whole, AI edifice is a huge amount of dilution in ROEs in China and Taiwan. Many of these operators, which operate out of China and Taiwan, which supply inputs to the hyperscalers, they operate at very thin ROEs or small margins. Their margins are low single digits. And that is one reason why these companies are able to, scale up so fast and become so profitable and then invest that money back into their businesses, which also means that there is a dependency, right? Maybe it can become a more geopolitical risk as we go ahead. As of now, it is non-existent, but I'm sure that this linkage over time, will have to be looked back at, and it can become a significant risk to this sector over time, right? So Initially, for now, what we have spoken about in the last few slides is we told you that the capex number is very high, and for that capex, what do we have in return? How much revenue is being generated is still questionable, and some of these capex numbers are so high that we have not seen them historically. Now, at the same time, markets have also valued this sector at a significant premium. So some of these companies put together trade between 30 to 37 times trailing multiples. And similarly, technology as a sector, its market cap is now about 41% of the entire market. This is done by using MSCI Acqui Index, and the weightage of technology, which includes IT and communication services sector put together, is about 41%. And this is now bigger than the dot-com era. Of course, there is a big distinction. In the dot-com era, these companies were not profitable like they are today. So many of those companies at that time were trading at 50 or 100 or even higher multiples, which is not the case. This time the multiples are lower, but lower is a qualification. I mean, 37 entirely is not a low multiple at all. But yeah, these companies are extremely profitable, and their market caps have, grown because their earnings have grown. But still, a sector which commands 41% of the entire market cap is by no means a small sector. These extremities are rare, and I think they need to be looked at when they occur, right? So now we are seeing this is, a remarkable extremity. Whether this is the top or not, this data can never tell you. All it can tell you that you have stepped into uncharted territory, and you've been stepping into that uncharted territory over the last 12 to 24 months. So it's not new, but yeah, you are in some sort of a territory which we haven't seen earlier. Next is a very important distinction of how this has happened. So we keep on speaking about technology as a sector, but if you look closely, we looked at the bifurcation of what has gained weight. And what we did is that we looked at industry subsegments. So if you look at technology as a whole, the weightage has gone from 10% to 31%, right? In the MSCI World Index from 2005 to 2026. Now, when you look at it, over, let's say, the last 10 years, the weightage has again gone from 10, 12% to 31, a big jump, right? But when you, look at the numbers more closely, dig deeper, you will see that software, let's say you start with 2017, which was about 4.8%, has gone to 7.1%, right? Slight increase in software share. There is a decrease from COVID from 9 to 7. But when you look at sectors like hardware and semiconductors, they have doubled or more than doubled. In case of semiconductors, the share has gone from about 2 to 3% to 15%, right? Roughly a five-fold jump. So, in fact, the whole rally that we've seen in technology is driven, at least in the last 2 to 3 years, entirely by the hardware and semiconductor sector, not by the software sector. So, that's why when we talk about this technology rally, it is actually a hardware and semiconductor rally when you look at it more closely. And when you look at the MSCI Emerging Market Index, the numbers are, outright crazy. From 2020 onwards, the share of semiconductors and hardware has grown significantly. The combined share, which was around 18, 19%, has gone to 46% or 45%. So, for example, semiconductors, which pre-COVID used to be just 5% or so, today account for 28% of the overall market cap. So the last bottom slide, you will see that domestically in Nifty 50, IT services, which doesn't have any hardware or semiconductor, the share has actually come down. So if you, let's say, look at the COVID and pre-COVID era, share used to be between 15 to 16%. At some point in 2017, when the sector was undergoing similar problems of cloud computing, etc., it was still 11.3%. Right now, it's 7.4%. This share is now lower than the lows of global financial crisis when it was close to 8.5%, 8.8% to be precise. So this is where the IT services are now, and this is the overall mix or change in technology where one part has suffered significantly, so much so that software now is not even labeled as technology, right? Hardware, semiconductors, and other hyperscalers are labeled as the new tech. But in fact, these nomenclatures keep on changing. And this slide also tells you that what has gone up in extremity will probably mean revert. What has gone in extremity will also mean revert. So we need to be very careful in judging these numbers. Some of these numbers, for example, the MSCI number of 46% or 45% in hardware and semiconductor is completely out of whack. Out of 100 rupees of sector, you can see that such a high weightage has gone to this two particular segments. Right now, we'll talk about slightly more deeper stuff in AI on what is changing. So first thing is that input prices have risen dramatically. Why this is happening? So if you look at the supply chain, so all of us know that AI needs a lot of computing power, and so when AI adoption rises or significantly increases, you need more computing power, right? And to have more computing power, you need more GPUs, right? And when you need more GPUs, that means you need more chips and high bandwidth memory or HBM. All of that needs rapid expansion because all of these AI models and companies are looking to get these chips and hardware, right? So therefore, this supply chain tightens, which leads to rapid increase in prices. And you can see that GPU rental pricing has gone up significantly, right? And the producer price index that we've shown for semiconductors, it has gone up significantly. Some HBM and other memory prices have multiplied. They have gone up 20-30x over the last 1 year or so. And which means that all the numbers that you see in terms of capex, all those are nominal numbers. When I talk about 580 billion or 100 billion or $1 trillion, uh, what is happening is that as prices go up, maybe the volume has not gone up significantly, but the expenditure to get the same chipset, to get the same GPU, to create infrastructure, it has exploded because these things become significantly expensive, right? So the overall, if you look at the capex, a large portion of that capex is going up also because of inflation, right? And all this money is coming from select set of companies using their cash flows to spend that money. And more recently, many companies have also started to borrow to do this capex, right? And therefore, it adds to more sort of extremity on the capex that is happening. Second is that computing itself is no longer, the only constraint. You need that infrastructure. So as I said in the last slide, uh, as the models increase in complexity, right? You use agentic models and reasoning and codecs. So earlier, when we had, let's say, the first LLMs in 2002, they were very straightforward. They utilized much lower infrastructure. We've tried to visualize it here. So the new agentic models and reasoning models, they require 1,000 times more tokens and infrastructure than the earlier models, right? And they also require huge amount of backend support through data centers, and their electricity consumption is also going through the roof, right? So these bottlenecks start to look more like a hindrance, and because it is becoming expensive and it is not very easy to get, right? Supply is constant and prices are going through the roof. And now, when you look at this whole story, you also know that at the back end, uh, there is this electricity generation, which is required to power these data centers and AI models. And there, particularly, China has started to, win the race, sort of. So, for example, in year 2025, China added as much capacity as the overall capacity of Germany and higher than the overall lifetime capacity, grid capacity of almost all other countries. One or two countries will be bigger than this, maybe US and Brazil and a few others. That is what China added in 1 year in terms of electricity grid. Annual electricity generation for China has now grown significantly larger than United States also, right? So these things tell you that China has stepped up. It is now also coming up with more open models, open weight models. It is trying to undercut many present AI models in pricing. which will automatically make it much more difficult for the earlier super giants in this sector to continue the capex, because if their revenue visibility gets challenged, um, their funding will also get challenged. So here, China's role is becoming extremely critical, and we have to be very, very focused on how this whole thing plays out. The next is, as I said, that with all the capex happening, eventually there has to be a return, there has to be a revenue. So if you look at this chart, it is taken from DSP transcript, which we released in June 2026. So every $1 of infrastructure capex must travel through the whole AI value chain. So if you spend $1 on infrastructure, then you get a compute layer, which comes at $1.5. So it adds its own profitability on top of $1. And then there are layers who create the models or LLMs or other agentic models, where the pricing goes to 2.7. And then the end user has to pay about $4. So you start with $1, the end user has to pay $4. So every the number, for example, we spoke about $1 trillion in capex. The total capex is much higher because we're talking about 5-year number now. Maybe it will get closer to $2 or $3 trillion. So for that, every year now you need about between $3 to $4 trillion in revenue from these AI, for these AI companies to justify the amount of capex which has happened. As of now, those numbers are not available. The expectation is that they will ramp up so fast that their revenue will go up significantly. Maybe that ramp up will happen. We have no clue and no way to estimate. But it looks like a steep ask. Why do I say that? Because when you look at the total global IT spend, it is about $6 trillion, and that whole sector is about 40 to 50-year old, right? So let's say that they're going to, sabotage the whole of global IT. Still, they will get about $6 trillion in revenue, which more or less will not be enough to look at the profitability, which means that it will have to bite into the overall $45 trillion global wage bill, right, to justify uh, the amount of spend that is happening, and which to my mind appears very, very difficult. Right? And therefore, at this point in cycle, we should be critical and probably fence sitters in this whole AI game, specifically the whole memory, HBM semiconductor game. And we should be more or less fence sitters and let the others take the harder calls. So this was the first section on AI. Second, we'll talk about India valuations and what is the Gulf. I'm sure the first section had a number of things which are not very common. So if you have any questions, you can put them in the chat box. We'll try to answer them. So now we'll talk about India valuations. It's a very simple section. We put together, what is happening overall. So one important distinction which this slide wants to make is that what should be the overall expectation for investors in terms of returns. Now, this is a question that is very, very important. So here we'll talk about the overall market. So when you look at the all the listed companies put together, what kind of equity return can they generate? So maybe think about in terms of the overall 500 company index or 1000 company index, the whole market, what kind of return can it generate? So we'll try to answer that question using some basic ideas. So first is that for all the companies, let's say we talk about the top 1,000 companies, there are only two markets. One domestic market, the other is exports market, right? So either they are selling in India or outside India. When they sell inside India, the overall sales growth will be very close to the nominal GDP growth rate, right? And here we are talking about all the companies put together, right? Of course, there will be some companies which will grow faster. There will be some companies which will grow slower. We are not making that distinction. We are talking about all the companies put together. So their growth rate will be close to nominal GDP growth rate. India's nominal GDP growth rate is between 10 to 12%. As we speak today, that number is actually 9. So we will not make that distinction. Let's say we go back to a long-term growth rate of 10 to 12%. That will be the nominal growth rate for companies or part of companies which are domestically driven. The other part will be exports. Exports growth, when you look at last few years data, is between 4 to 5%. Add another 3 to 4% of INR depreciation. And if you want to take the best period also or worst period, you can still assume that export growth will be between 7 to 11%, right? You can take these numbers, you will be able to see why am I saying that? Because a dollar growth rate of more than 5-6% is not easy, right? It's a very difficult task. You can look at it globally. For any country, any company, you will find it that it's a very tough hurdle to cross. But let's assume that the whole export basket is able to do that. So nominal GDP growth rate of 10-12%, export growth rate of 10%, which means that top line for companies or sales growth for companies will be between 10 to 12% over a long period of time, right? So if revenue growth is 10 to 12%, what will be the PAT growth? Now, PAT growth is a function of A, you can sell more, B, you can sell better, which means that your margins can be higher. But when you look at the current margins for Indian corporate, all the companies put together, we are already at lifetime high, close to lifetime high, which means that there is very little room for margins to expand from here, right? They might expand a bit, but you can't bet in favor of margin expanding. So if margins are not going to expand, your PAT growth is going to be very similar to revenue growth, which is the 10 to 12% bucket. And what will be the equity returns? Equity returns follow earnings growth, right? They can follow earning growth plus or minus the valuation change. Now, we don't know valuation will be high or low, right? I will talk about that also. But the crux of the matter is that equity returns will mirror PAT growth, PAT growth, which is going to mirror top line growth, right? And what will be the investor return? Whatever expense ratio you pay or brokerage or transaction charges that you pay, you subtract it from it. So if you start from 10 to 12%, your expectation should be less than 10 to 12% in terms of overall longer term return. Now, the question on valuations. If you buy companies which are expensive, right, the probability of you realizing that 10 to 12% will be lower, right? And if you buy companies which are cheaper or trading below average valuations, the probability of you realizing that 10 to 12% will be higher. Now, this is how you should think about returns. I'm sure there is a segment where people will focus on companies which are growing at, let's say, 25% or 20% or 30% and delivering much higher equity returns. There, it is possible to capture some of them, but you have to make sure that you don't overpay, right? If you, let's say, pay a multiple of 40 times or 50 times for a company growing at 25%, there are high chances that you will once again make only 10 to 12% return, right? So you have to be very critical of valuation. So if there is a company which is growing strongly, is of very good quality, and it is also cheap, then I think you will find a great investment. But finding those great investments are not easy, right? So this is how you should think about returns. Now we come to the overall valuations. We've seen a D-rating, and current D-rating has taken Nifty price to book below long-term numbers. On a trailing basis, we are below long-term average. On a forward basis, also we are below long-term average. One distinction is that the current price to book is similar to the COVID era price to book, which was December 2020, but ROEs are much higher at this point in time. So you could say that this price to book is of a better quality than we saw in 2020. And mind you, these are only Nifty companies, right? This is not the NSE 500 universe. And therefore, there is a distinction that some of the larger companies, which is part of Nifty 50, have become much more cheaper. And as we go ahead, I will show you that also. Similarly, on price to earnings, the market is not cheap, but it is very close to average multiple. You can say it is between average and fair. At the March lows, we spoke about it, that market had probably reached close to its fair value. Now we are maybe 10% above it, and we are also seeing earnings come back up. So maybe we are in that hazy zone of, let's say, average valuation and fair valuation. Certainly, we are not cheap. You will see cheap multiples only during crisis, and I don't think there is anybody who can predict crisis. Crises occur out of the blue. When they occur, you get cheap equity valuations and you get lucky. As of now, we are not seeing any significant crisis or cheap valuations, right? So we continue to hover close to averages. Small and mid cap universe is in a different zone where median multiples are much higher. And as I said initially at the beginning of this section, that of course there will be some companies right now in mid and small cap space which are growing at much faster rates than some large caps. Some large caps are also growing fast, but certainly there will always be some companies which will be outgrowing that 10 to 12% bucket. For that, you have to make sure that valuations are not too high, because as a cohort, when you look at it from a full 400 stock perspective, it is not cheap. They trade at a median multiple of 38. So you have to be very selective in how you select mid and small cap, largely only through active funds and only through SIP. Also, in terms of prices, then you can see they are much higher than they were historically. They are close to peak versus large caps, right? Versus large cap, mid and small cap are very close to their lifetime peaks. Certainly not a very exciting or juicy area to be bullish about them. And therefore, you should read with caution in this segment. We've seen from March lows, they have done exceedingly well, outpacing the large cap by a very wide margin. Uh, but my sense is that 1 or 2 quarters of price performance is usually a lot of noise, whether it is in the favor of large cap or in favor of small and mid cap, and we should not take that as a sign of long-term performance. We should be focused on what numbers are saying. Next is the overall complexion. This slide is more for your reading. We've shown where, in which segment of the market is value beginning to emerge. You can see some, uptick in the green areas where some cheaper segments have started to come back into the market, but it is still not enough. It is not similar to era. So broadly, when you look at this chart, you will be able to make out that on a very broad spectrum, you still have to be very choosy. You have to choose what you want to buy. One distinction is at this time, there are some bargains available in some sectors like financials, IT, some healthcare companies, auto, insurance, etc. So you will be able to find bargains which were somehow significantly absent in 2024, but now there are certain areas and pockets where you will be able to find bargains. Um, as I said, they are not easy to find. You will have to look for them. But certainly in some parts of the market, you can see the buildings have gone up where multiples are below 20 times. Earlier, these buildings were much smaller. You can see out of the BSC 1400 plus company list, at least you can find, about 450, 500 companies where you will be able to get some bargains, right? Which is a big universe. So you'll be able to make a much better quality portfolio looking at these valuations. Another important distinction from a price perspective, some of the readers of DSP Netra will remember that we wrote a piece called The Unsettling Calm, right? Where we wrote that markets have been on a tear, they are rising so fast that they have forgotten how to fall, right? This was back in 2024. And we said this is a sign of risk. And eventually the markets mean revert, and they are likely to cool off and either go through a time correction or a price correction. Fortunately, we saw a very benign sort of a bear market where price correction has not happened, but time correction has happened. And you can see that in the current correction phase, Nifty has spent more than 103 days below the 200-day average. But the drawdowns have not been very large, right? What it does is it eats away the long-term rolling CAGR, right? And what it does is it brings down the return to a more normalized level, right? From a breakneck level. And as you know that all things mean revert, all returns mean revert. This is a good outcome for long-term investors because eventually when short-term or recent returns normalize or they come below their long-term numbers, you have a better possibility or higher probability of realizing better returns into the future. Or let me rephrase it, low recent returns or sideways recent returns are a good place to be for better future returns, right? And this analysis tells you that it has happened over the last 2 years, that markets have not gone anywhere, and it has cut down on its overheating froth in terms of price. And again, this is the Nifty index, largely representing the large cap universe. Similar things happened in small and mid cap also, where the net 2 year change is still zero, right? Both these indices, maybe Nifty is below the 2024 mark by maybe about 8 to 10%, and small and mid cap are at the same mark. But roughly the overall return trajectory has been flattish. Um, this particular slide is about leverage. There is a MTF book we wrote about it in 2025. You can go back to the DSP Netra that we released there and read it once again. But here we have shown that the overall leverage in the market has gone up. It has gone to 0.41% when you compare it to the market cap. And in leverage, we count the MTF book, the last book from banks and from NBFC. So the total leverage is close to 195 thousand crores or 1.95 lakh crores. Certainly, it's not a scary number as of now, but it's not a small number also, right? 0.4% of market cap and about zero point 0.8 or 0.87% of free float market cap is not a small number, specifically when you add the huge, humongous FNO volumes that happen in India, right? Which is unlike many other parts of the world. It does add to, some uncertainty, some overhang. And why does it do? Because in itself, leverage cannot create trends, right? It cannot create a bear market or a bull market. What it does is it amplifies them. So if you get a bear market or a market which is fundamentally on a slippery slope, this leverage will amplify the downside. It will create more downside, right? And certainly we have that kind of leverage and participation which can do that. So, but have we hit some sort of a number which is alarming as of now? I don't have an answer to that question because if you look at some global parallels, in some countries the leverage is even higher. One simple cited number is the margin debt in US, which is 2% of free float, 2.15% of free float, much higher than India, more than roughly three times of what we have. But that's a very fundamentally different market and a different way of lending compared to what we have in domestic market. So both are not you know really comparable. But have we reached that kind of a number? In many other countries, the numbers are much higher. We haven't reached those numbers yet, right? So, but yeah, certainly it's a point where we need to keep in mind that if markets conditions deteriorate, it can certainly make uh, it from bad to worse, right? The last slide, we touched upon DSP Capex tracker, where we track all the important segment which shows what is happening to capital expenditure in the domestic economy. And you can see that some numbers, and we are beginning to see that some numbers have started to improve. Capital expenditure in India has started to become better. We have started to see some green shoots or some signs of recovery, certainly in the last few quarters. And that's why we put it here. Data like industrial credit, IAP, capital goods, cement volumes, BSC capex itself in the last 2, 3 quarters. These numbers have started to improve and they were not improving earlier. One thing which has kept the recovery, on a strong footing was the central government capex. That number has slowed down. Maybe it will be slow in FY27 also, but the private side of things has started to pick up, which is a very good sign. And we'll report more of it as things improve further. So this brings me to the end of this section, and I will probably end with this slide uh, that there are a lot of models, lot of back testing that is done, and when we look at these models and hypotheses, in our mind we think that they will function in a certain way, in a beautiful way, and but when we implement them in a testing environment or in our Excel sheets, they work slightly, they are slightly worse off than what we had in mind. And in real life, the outcomes are totally different, right? And therefore, we can't extrapolate just the data because real life has a lot of randomness, lot of things that are beyond our control. So it is very important to not get caught in, um, you know, output from an Excel sheet or, for forecasting errors and focus on all the things which can go wrong. So with this, I will stop here and I will invite Pragati back and we can take some questions from the audience. Thank you.
Thank you so much, Sahil. We have a couple of questions. So I would want to go section wise to start with. So we'll start with the section on AI CapEx, the questions around that. So the first question is, If AI infrastructure spending has already reached a scale comparable to some of history's biggest investment booms, the first slide we you talked about, what would be the earliest economic indicators that tell us this investment is actually earning an acceptable return?
So largely, we should see a big revenue bump up in most of these AI companies. I think that will be the first trigger, and maybe they will take away market share from other historical or traditional companies. That will, I think, will be the first trigger to ascertain whether this AI capex has resulted in the commensurate returns or not. Eventually, the profitability will have to flow in, but at least revenue will give that visibility that this sector is becoming material in terms of attracting business.
Okay. So another follow-up question around this. You talked about how rising AI capex may increasingly reflect higher hardware prices rather than proportionally higher computing capacity. How do you think investors should distinguish between nominal investment growth and real capacity creation?
So largely, I think it is a reflection of the prices themselves, right? So how to distinguish between the two is that you will have to look at the prices of these essential hardwares. If these prices are very high, you can ascertain that real growth is lesser, right? So, for example, one index that we have used in our report, of the PPI index of semiconductors and other equipment, you can see the change in that number and then compare it to the overall revenue increase for, let's say, semiconductors and HBM companies. If that number is very similar, that means that volume growth is very low, and it is all about pricing, right? Which will give you a gist that it is just a supply bottleneck which is causing these numbers to inflect higher. Real volume growth is not happening. So that is again an indicator that you can.
Okay. Okay, so the next question is around, how the sectors have rotated within the technology segment. So India, as you mentioned, has largely missed the semiconductor-driven AI re-rating because its technology sector is dominated by software. Do you think this could eventually become an advantage if the current AI investment cycle begins to normalize? Another question around this is, could India's market composition itself become a source of diversification over the next cycle?
So one thing is clear that of course Indian market is much more diversified versus whatever is working in the world right now. Right? So when you look at even the US market and if you subtract the top 10, 20 companies, other sectors have been more or less sideways. They haven't seen significant uptick compared to the technology space. Similarly is the case with the MSCI Emerging Market Index. In fact, in the last Netra, we published that the YTD returns of MSCI Emerging Market Index, all of it has come from technology, right? And nothing from outside. And within tech, it is semiconductor and hardware. Right? So it's very clear that Indian market is, of course, much more diversified, which gives you a broader exposure. So if this whole technology, especially the semiconductor and hardware theme, slows down, maybe India will become a differentiated bet. Whether it will benefit or not, it's a different scenario. I think it all depends on domestic earnings growth. And as far as the IT sector is concerned, whether it will benefit or not, jury is still out. Um, I think if the real world is, let's say, less of doomsday than what we have today, and then probably we'll see some walk back, right? Some of the revenues which have not been coming for IT companies will probably come back, right? How much of it will come back, only time will tell.
Makes sense. Okay. So, Sahil, there was this one slide where we talked about how the equity returns are capped by the nominal growth and the exports growth, right? In our previous editions, we did talk about the consumption aspect of this also, right? So, how do you think we can marry the concept of private consumption in this idea, which we talked about, how equity returns are capped by the nominal growth?
So private consumption has more or less followed the economic trajectory, and there were periods when it was outgrowing it, right? We have seen historically many periods in which private consumption in India, or specifically the PFCE, has been much stronger than the nominal GDP growth rate, headline GDP growth rate. Right now, we are in not that not in that phase, and we've written historically, at least in the last few segments, that we might get into such a phase where private consumption begins to do well. If that is the case, then domestically oriented companies which benefit from private consumption will probably find it easier to do higher sales growth, right? And that I think will become a very good cohort to look for investment ideas.
Makes sense. Uh, Another question. India's investment announcements have picked up, but much of the recent spending at least seems to be concentrated in data centers and nuclear power, right? So, what do you think this tells us about the breadth of the current capex cycle in India?
So as of now, I think it is not broad. As data suggests that there is some pickup, we are able to see some pickup, but it's not broad. Most likely, it can become broad-based if more of infrastructure spending picks up in road, railway, ports, housing, real estate sector. I think that is a more desirable place from a broader economic standpoint. There are some improvements, but it's not broad enough, right? So we'll have to wait and see. But of course, it's becoming better than what it was in FY 25 and 26.
Okay, we'll take two, three more questions around valuations. So you've talked about how aggregate earnings cannot sustainably grow much faster than nominal GDP growth in exports. I did mention this previously also. Do you think this imply investors should lower long-term return expectations as well?
Yeah, I think so because see, over the longer term, also the drivers of returns remains only two, which is one is earning growth and the other is valuation, right? And earning growth, we have to look at it from, from the perspective of what will be the overall revenue growth and what will be the margins, right? So these levers are the only ones which will decide what is your earning growth. And as I said earlier, for top line, you have to look at the domestic economy and export growth. There is one, of course, very important lever of margin expansion and contraction, which plays into the hands of how much returns we'll get. Of course, I kept the valuation lever out, which I think is one of the most important levers. So, if I put all these things together, if you buy stocks which are going to grow their earnings at a decent pace and you buy them cheap, then probability of you doing better than the overall market goes up significantly.
Okay. Another question. Investors often spend a long time forecasting earnings. In your experience, is understanding expectations embedded in valuations ultimately more important than forecasting the earnings themselves?
It does seem to be the case. I think first trigger has to be how much you are paying for the investment. Of course, earning has to come through, right? If there are no earnings, of course, the businesses will not perform. So PAT growth eventually, the delivery of PAT growth and more specifically free cash flow is going to be the deciding factor, not just the valuation. Both are joined at the hip. So you can't ignore one and do the other. The only thing is that forecasting earnings is almost impossible, right? So the only thing that you can choose is choose those businesses where the probability of maintaining earnings is much higher, right? And that will probably give us some sort of visibility. For others, I think who are specialists in particular sectors where they have some deep understanding and knowledge of what a sector could do. There are investors who can do that. They will probably gain much more from projecting earnings, but it's not an easy task. It's a task which is fraught with risk.
Makes sense. I think that's it for all the questions that we had. Thank you so much, Sahil. And thank you all for joining us. We will see you in the next call.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.